Hello everyone, welcome back to Chapter 7, Financial Services in Your Daily Life. Today we're going to continue with prepaid debit cards. Prepaid debit cards are unique in that they are not linked to any bank accounts. There are store-specific card versus general purpose card. There are also cards such as payroll card or benefits card. So store-specific prepaid card, some of you may have received that as present during Christmas time. You may have an Apple card or an Amazon card or a Steam card. Those are cards that allow you to buy games on Steam or buy anything you want on Amazon. So just like credit card, a store-specific prepaid debit card, you can only spend it on merchants from that particular store. And there are many of them, and you probably see them everywhere. They range from restaurant prepaid debit cards to Amazon, Apple, and so forth. General purpose prepaid debit card can be used anywhere. They will have the same logo as a credit card. So the general purpose prepaid credit cards are often issued by Visa or MasterCard. A lot of times nowadays, some companies use prepaid debit cards as payroll card. So they pay their employee instead of cash or check. They pay them via a prepaid debit card to employees who do not have a checking account. Some government agencies also pay benefits on prepaid debit cards. Those are called benefits cards. With prepaid debit cards, the most important thing to watch out for are fees. Some prepaid debit cards charge activation fee, so you need to pay a fee just to start the card. Each transaction you use the card for may be subject to a fee. If you don't use the card, you may have to pay a maintenance fee. And every time you put more cash on it or you take cash out from an ATM, you'll also be charged a fee. And if you don't use the card at all, you may be charged an inactivity fee because they are no longer making money off of the transaction fee. The textbook show examples of two debit cards. So here's one debit card. You can see there is a monthly. They have different types of cards. They have a monthly fee, and if you pay the monthly fee, you don't pay for transaction. On the other hand, pay as you go. You pay $1.50 per transaction. ATM fee every time you put money on. Balance check. Inactivity fee if you don't use the card for 90 days. And they charge 8 other types of fees. In contrast, this is another debit card, prepaid debit card. This is a Michigan benefits card. This is issued to benefit recipients in Michigan. Monthly fee is 0, per purchase fee is 0. ATM, if they use in-network, is $0, $1.50 for out of network. And they do have an inactivity fee, but it's only $1.50 after 180 days. So prepaid debit cards come in many different varieties. Reading the fine print is very important. Since prepaid debit cards is not linked to any bank account, they can be anonymous. They do not have any identifying information. They function just like cash. If you lose the card, it is gone. All the money that's on it will be gone. If you use a prepaid debit card, your transaction will not be traced. There is no record of it. You can choose to register your general purpose debit card. So store-specific cards are not qualify for this. Only general purpose card can be registered for protection. If you register the card, when you register, you have to give your personal identifying information. If you do that, then it will limit your liability for unauthorized charges if you report them within 2 business days. And if the issuing bank is insured by either FDIC or NCUA, the balance that you have on those prepaid debit card is also subject to the insurance, so you are protected. And this 2 protection is only available if you register your card. Prepaid debit card is important because person-to-person or peer-to-peer, P2P payment apps are becoming more and more popular. And you'll see in a minute why that's the case. These apps are currently unregulated, and each app has their own policies. You can link this app to your bank account, a debit card, or a credit card. Be careful when you use a credit card along with a payment app, because some credit cards treat payment apps as cash advance. And if the credit card treats the transaction as a cash advance, you'll be subject to the cash advance fees and the higher interest rates as well as transaction fees. Before you link a credit card to a payment app, make sure you check the fine prints. If you use the credit card with a payment app to pay a merchant, usually that does not result in cash advance. But if you use a payment app linked to a credit card to pay a friend, you're basically giving cash to a friend, and that may result in cash advance fees. Payment apps have quite a few incidents of being hacked and also scam, meaning that people are being tricked to send money to impersonators. To protect yourself, it's a good idea to limit the amount of money in the checking account or debit card that is linked to these apps. Personally, I opened a separate checking account that is dedicated to linking to payment apps, so that checking account is not related to my regular checking or my payroll, so that I can limit the amount of money that is exposed to potential scammers. If you have balance in these payment apps, those balances are stored in a virtual prepaid debit card. And therefore, everything that we talk about prepaid debit card will be applied to any balance that you have in these payment apps. If you register the app account, then you will be protected against theft and bankruptcy, just like what we talked about before. So if the bank that the app you use is connected to a bank that is FDIC or insured, then your fund balance is protected. And also, if you register your account and your app account get compromised, if you report it within 2 business days, you can limit your losses to $50. So when you're using payment apps, you really want to watch out for scammers, because they are a lot easier to hide or to impersonate somebody that you know. Digital wallets are very different from payment apps. Digital wallets, all it does is store credit cards and banking information. It's just like the name implies, it's a wallet. You're putting your card information into the wallet. The wallet itself does not contain any money and is not linked to any bank. You can use digital wallet to make payments in person or online. So Apple Pay, Google Pay, Samsung Pay, those are digital wallets. No money is transferred into or stored in the wallet. All it does is it takes the information from the card that you store and then submit it, instead of you personally typing in the card information online or you swiping the card on the store's card reader. You tap your phone and the phone does the transferring of card numbers onto the machine. Digital wallets are not regulated at all because there is no money transfer. All that it does is it store information and it submit and transfer information about your credit card number or your bank account number. It does not take money out of your checking account or out of your credit card. A new phenomenon that has become very, very popular in the past few years is buy now, pay later. Buy now, pay later is actually a form of installment loan or unsecured credit. They actually have relatively high interest rates. The buy now, pay later advertise that there's no interest rate. You buy now and you pay in 4 payments and there is no interest. That is true if you make those 4 payments. A study has found two things. One, they found that consumers buy more when they're paying with buy now, pay later. So some people, not everyone, but some people are spending unintentionally when the buy now, pay later option is available. More importantly, over 70% of buy now, pay later users end up paying interest charges, meaning over 70% of people who use buy now, pay later do not make those 4 equal interest-free payments. Remember when we talk about consumer credit, some bad reasons for using credit is excessive spending and accumulating debt. Buy now, pay later seems to be an option that encourage people to spend more than they intended and also accumulating debt that they also do not have intention of doing so. Another option to pay your bill is rent to own instead of buying it. Rent to own is a lease, not a loan. What that means is that you do not own the item. It's right in the name. It's rent to own. You do not own it yet. You're renting. If you don't make all the payments, you are still renting. It's until you make the absolute last payment that you own the item. If you miss any payment at all, the item can be repossessed, and all the payment that you have made will be gone because those are considered rent. If you compute the interest rate or the implied interest rate that you learn how to compute in the time value of money chapter, you'll see that a lot of them are very, very high. In some cases, the interest rate is over 300%. Now that you know what a bank is, what type of bank accounts are available, and credit cards, debit cards, and payment apps, how do we use these services in a safe and responsible manner? First and foremost, be vigilant. You want to monitor your account balance and have transaction alert. The easiest, mobile apps makes this very easy. You can check your balance. It will take seconds. You can set up transaction notifications. So anytime a debit, meaning that money is taken out of any of your account, you get a notification. Any purchases is made, either using your bank account, debit card, or credit card, you can get a notification. That's just a good practice. Do not keep all your money in a single account, especially the account that is linked to a mobile app. Here are some options. You can use your savings account or your money market account for deposits from your payroll. And then you can transfer money from there to your checking account when you need. If you have done your budget, you know approximately how much money you need for your regular expenses. Some employers allow you to split your deposits into multiple accounts. Not all employers allow that option. If they do, this is a good option because that allows you to put money that you intended for saving into your savings or money market account that earns interest. Common online safety practice: use good password scheme, complex password, MFA, multi-factor authentication, and watch out for phishing emails and scam text. Part of financial planning is planning. So be aware of transaction rules. Again, the textbook goes into much more details about this. Know that the deposits that you put into an account may not be available right away. So you want to know your bank's fund availability policy. The textbook go over examples where if you make a deposit after 3 p.m., it may not be available for a number of days. And checks and payments sometimes may take days to clear. So you want to set up payment reminders on your calendar so that you make your recurring payment ahead of time. Schedule at least 3 business days so that in advance for your payments to clear. You can set up automatic payment to transfer money from your savings account to your checking account and vice versa. So you want to pay your bill on time. Remember, that's the #1 factor affecting your credit score. You can either use paper check or online digital online banking, so that gives you an electronic check. You need to make those payments at least 3 to 5 days before the due date. An advantage of using online bill pay is that the balance, once you write a check or once you specify a payment, that amount will be deducted from your available balance. So you know how much money you have left in your checking account. Overdraft protection, we already talked about that. The downside is you may expose your other accounts that you link to the overdraft protection to scams. The advantage is that if you have insufficient funds, you can avoid that. It's a balance between the two. For ATM, watch out for ATM fee. This goes back to when you choose a bank that has a convenient location near your daily life, you will be less likely to use an ATM that is out of network. We spent this entire chapter talking about banking. Why is banking important? That is because if you are unbanked or underbanked, it can be very expensive. So what is unbanked and what is underbanked? Unbanked is defined as a household where no one has a checking account or a savings account. According to a survey by the FDIC, about 5.8 million households, or 4.2% of Americans, were unbanked in 2023. Underbanked is defined as a household that has a bank account, but it doesn't have access to other traditional financial services, such as getting a credit card or getting a loan. And about 19 million households were considered underbanked. So altogether, 1 in 5 households in America is unbanked or underbanked in 2023. The top reasons given for unbanked is they don't have enough money to meet the minimum balance requirement. And the second reason is they don't trust banks. So hopefully by learning about how banks operate and the protection that is available to consumers, you can increase your trust in banks. The disparity among racial groups for unbanked and underbanked is quite significant. As you can see, for white Americans, the unbanked percentage is very, very low. On the other hand, Hispanic and Black Americans and Native Americans, they are much, much higher. Why do we care about unbanked and underbanked? And the reason is it's very costly. It's not just costly, it's also inconvenient. For example, if you don't have a bank account, you cannot cash a check. And cashing a check can cost $10 per check. And if you cannot obtain a loan from a regular bank and you cannot get a credit card, a payday loan can charge you more than 400% in interest. A 2019 study found that the unbanked and underbanked Americans spent $189 billion in fees and interest on the financial products offered by payday loan and check cashing services. And this is back in 2018. There has not been any more recent study. The services they often use include payday loans, check cashing services, buy here, pay here car finances, and car title loans. Let's take a look at an example of how expensive payday loans are. Payday loans are lightly regulated, and they are regulated by states. So some states have more strict rules and some have less. Most states have a maximum amount of payday loan fee. Some are $10 to $30 for every $100 borrowed. So let's take a look at how much that really is. It may not sound like a whole lot, $10, but it's $10 per $100. Let's take a look at an example. Most people get paid every 2 weeks. Let's say you need $400, and the state law says that they can charge $20 per $100, so the middle of the range. So if you borrow $400, 400 times $20, or 4 times 20 is $80. So it will cost you $80 to borrow $400. If we divide $80 by 400, that'll give you 0.2 or 20%. But that's 20% for every 2 weeks. There are 26 pay periods in a year. So if we multiply 20% by 26, that turns to 520% per year. And that's assuming that you borrow $400 only once. If you get trapped into a cycle, so 2 weeks go by, you don't have $480 to pay back because it charged. You borrow $400, there's an $80 fee. You have to pay back $480. If you don't have $480 to pay back, you have to borrow $400 again and pay $80 again. And that means that you are adding interest to the balance again. So it's the next time you have to borrow $480 because you don't have money to pay back. And some states does allow that to happen. It allows the lenders to automatically roll over the loan when it becomes due. And if that happens, you take into account compounding, the annual percentage yield is as high as 11,000%. So even if you ignore compounding, it's 520% per year for a payday loan. And this is not atypical. Remember that most states allow $10 to $30. So we pick $20, that's the middle range. Here are some steps you can take to become a bank household. And you may be someone who can help a friend or a family member. You can help them overcome myths about the complexity of banking now that you have more knowledge yourself. In the chapter on consumer credit, we provide some resources on credit counseling. You can find banks that do not require minimum balance. And many banks will waive fees if you agree to direct deposits from your payroll. Finally, there are special programs in a lot of banks designed to help unbanked households. These are all steps you can take to become a bank household. This concludes chapter 7. I'll see you back again soon, and we'll go into the next chapter.